Hey guys, welcome to, if not one of the most important videos that you guys need to fully understand and conceptualize when it comes to credit card funding, credit card stacking, or just applying for any sort of financial products. And the reason why is because there are other external factors that influence the way that the banks look at their decisions when you submit your applications. And today what we're going to do is outline some of those factors aside from your typical factors that you see on your credit report, which does play a big part of whether or not the type of limits you get approved for, and then also if you get declined or approved in this case, right? So basically, banks are secretly judging you based on reasons they would never tell you about. And what we're going to do is really underline each of those reasons so you guys have some sort of like idea on, hey, if this is something that it just brings it to awareness and then bring it to the surface level. So now you guys do understand, hey, if there's certain things that we can work around or kind of like tweak throughout the process, this is what we're going to be focusing on, right? So one of these methods that the bank like to use could be the reason why your applications get declined far more than other people. Banks like to hide the fact that they create their own internal credit scores, scoring system for each customer aside from using the FICO score, and they approve and shut down accounts without a human being present. And there's one thing that's completely out of your control that directly affects whether you get approved or not on a regular basis. And most of the information comes from two separate interviews with large corporations like back office executives, and then also we have like primary underwriters that we work with, so we gather a lot of data points from there, right? So number one, what we're gonna be talking about is what we call internal scoring models. So aside from using the FICO A scoring model that Experian, Equifax, and TransUnion provides to the underwriter, banks typically have their own internal scoring model on top of the external scoring model that they have. I'm not sure how much weight it influenced the decision, but we'll kind of like go into a couple banks that actually integrate that model, and then give you kind of like some of the examples in the past of how that kind of influence the decision making when it comes to applying for their lines or their credit cards, right? So banks have their own way of figuring out if someone is a good bet for a loan. They don't really rely on just the FICO score, like I just mentioned, which is the number most people talk about when it comes to credit score. Instead, they have their own scoring algorithm, and they always tweak that. It might be on a month to month basis. Maybe it's based on a quarter. Maybe it's based on how the economy is doing, how lending conditions are in the economy at the moment. And these model look at a bunch of different things, not just your credit score, right? So, for example, Navy Federal Credit is well known for its internal scoring model, which is mainly based on, and they're used that to judge and approve you for any new products that you apply with them. One big thing banks tend to look at is how you've been making your payments. It's just not about whether you pay on time, but also how regularly you do it and how much you pay. Like if you always pay your bill full on time, that looks better than if you're just paying the minimum amount now and then, right? So speaking on top of that, just to add on top of that, for example, it's like they monitor how often you log into your credit account, how frequent you pay or make payments on a month to month basis, right? So for me, I like to really flourish my relationship with American Express because that's one of the banks that have the most amount of products. I have over 15 different products with them. So I want to make sure I log in like once every other day, and I will make payments to each of my accounts every week, right? So the frequency is, instead of doing once a month, which is kind of like what the standard industry averages, I do it 4 times a month, right? I don't necessarily have to pay off all of the bills at once, but I'm showing consistency and frequency in making some sort of payments towards these accounts just to bring those balances down, because they do spend a lot on their accounts, right? Navy Federal Credit, on the credit union, just to give you like a backstory. So I already have a car loan with them, and then my credit score kind of like took a big hit and it dropped to 630. However, given the perfect payment history and on-time payments I have with them in the past 2 years, I applied for another car loan. I was automatically approved even with a subprime credit score of 630, right? And that was years ago. So it's basically telling me like, if I were to, go with a different lender that I have no relationship with and apply with them, they'll automatically decline me just because of my FICO score. But given that Navy Federal have their own internal scoring model, and I have such a great history, payment history with them, I have relationship with the other products, and they can kind of monitor that over time. The likelihood of them overlooking that credit score and approving me for a different product is a lot higher compared to a third party company that I'm working with, right? So that's where I understand, hey, Navy Federal just don't only look at your FICO score, but they also monitor your your their own internal scoring model in that case, right? So this is a couple example. I'm sure there's other banks that also use their own algorithm like Amex, right? So that's why a lot of times they don't pull your credit as long as you're an existing customer of them, is because they have their own internal scoring model. They monitor all of the different factors that happens with your existing accounts, and they make a decision based on that, regardless of where your credit score might be. Obviously, your credit score is still going to be a big factor, but sometimes they're willing to overlook it as long as you have a good standing with some of their accounts and then also a perfect payment history, right? Another important part of their scoring is how much of your available credit you're using, and this is what we call credit utilization. This is very common stuff that you should already know. If you're maxing out your credit cards all the time, that might worry the bank. And it looks like you're struggling financially or not great at handling your credit. But if you're only using a small part of your available credit and you're paying your bills on time, that's a good sign. It shows that you're responsible with credit, right? So that's pretty common sense stuff. So these internal score model help banks get a clearer picture of your financial habits and how risky it might to lend you money. Another big one is credit line management. In the world of credit cards, banks are like detectives, and I have another backstory for this too. They keep a close eye on how you use your credit card because certain habits can tell you a lot about financial health. They take notice when you start piling a lot more credit card debt. And this quick jump in debt is a warning sign for them. It can mean that you're in trouble or you're not managing your money as well as before. Another key thing banks look out for is if you stop making your credit card payment in full, like the pattern of like the sort of payments that you make, right? You might be making full payments and all of a sudden you make minimum payments. And that change is a big deal. It suggests that you might be struggling to keep up with what you owe. And when you only pay the minimum, your debt doesn't decrease much and you end up paying much more interest over time, and this is risky for the bank, right? When the bank notice these sort of changes, these change of pattern in the type of payments and how much in payments that you're making, all of a sudden in debt or just making minimum payments, they take a closer look at your account and they're trying to figure out how risky it is to let you keep borrowing money, right? So keep in mind, banks is in the business of not only making money but also mitigating risk, and a big part of it is they have algorithm and processes in place to make sure they recognize any sort of pattern that might increase risk for them, for the type of debt that you're holding under your consumer account or under your business account in that case. And based on what they find, they might change your credit limit or watch your account more closely. So this is where I'm gonna tell you about a backstory, but the concept that they like to use is called universal default, and this is a term banks use when they take negative action on your account because of a problem you had with a different credit card company. So, for example, if you didn't pay a bill on a different credit card, your bank might react by shutting down your account with them, and they will do this because they see trouble with another institution. It's a sign you might have a problem with them too, right? So this actually happened with one of my Chase cards back in like 2020. So it was so funny. I got approved for a Bank of America card, and then I put it on a charge, and then ultimately I got scammed on that. It was a package. It was like a marketing package. It wasn't the that company didn't deliver on what it's promised. I made a payment and I was asking for refund, and I decided not to pay because this is a huge purchase and I felt like I got scammed. I don't want to pay it. So my account with Bank of America got closed, and I just let it go into collection because obviously I can fix that later on. And then what happened is this is where the concept kind of like dived in. I guess banks, they communicate with each other with a different external system, which allows them to see, hey, how you're performing with their products with a different institution, and they have a database to kind of like keep track of it, right? So basically what Bank of America is doing is kind of like communicating to that system, which Chase have access to, that hey, Felix didn't pay this credit card in time, and it's probably going to go into collection pretty soon, so he is a little bit risky, right? Just be that's a big warning or big red flag, as kind of like a signal to other banks. So Chase pretty much recognized that and decided to close my card out of the blue and gave me a really vague reason when ultimately I know the reason is because of the Bank of America account, right? So this is where universal default rating comes in, and you just want to be very careful with just be mindful of like what's going on with your other accounts, and then make sure to kind of like make some sort of commitment to start paying those high balance accounts over time, because that might cost a change of limits on your current cards with other banks, right? Next one is account shutdown. In the worst case scenario, how banks decide on whether to close your account is mostly due by computers and not people. Okay, they use complex programs called risk models to make these decisions, and these models look at a bunch of stuff about how you use your credit, like how much of the credit limit you're using, how you're paying your bills, and if your credit score goes up or down. And an example is if you're suddenly starting a lot more of your credit limit or change from paying your full balance to just the minimum, the bank system might see that as a sign you're at a higher risk of not paying back. So the computer might automatically just adjust your credit limit or lower that, or even decide to close your account to protect the bank, right? So that's why sometimes some of our clients are kind of like dealt with that, where their accounts just automatically got shut down out of the blue. It's because they start max out their credit cards right off the bat, right? A full bat like the moment that they get approved for 50,000 or $30,000 credit card, they liquidate the entire thing. And that's where the account shutdown comes in, because it's not your typical pattern to see a max out credit card within the first 14 days of getting approved for a card. So what we recommend is once you get approved for a brand new credit card, especially if it's a brand new credit card with a high limit and you already have kind of like plans on using all of those limits, do it in a strategic way and spread it out within 3 or 4 months. Don't max it out right off the bat, because that can cause a lot of like red flags, or you know yeah, it can cause a lot of like red flags in that case, right? Because of these automated systems in place to help the bank manage risk in a fast and consistent way without any human or yeah, any human interaction. Credit limits, when the banks decide on your credit limit, they really look into a few key things about your financial life, your existing credit lines, right? So this is what we call our comparable credit. And then let me just spread this out. You guys will still have a copy of this as well, right? Your existing credit lines, banks would take, that's what we call comparable credit. Banks take a peek at the credit you already have, like other credit card or loans. If you have good history of handling these well, is a big plus. It shows that you're good with the amount of credit and can be trusted with more, right? So obviously, if you're coming in with a $500 credit line with other banks, the likelihood of them getting you a 20,000 credit limit right off the bat is very unrealistic, because again, they use what we call they compare your existing credit lines to justify the type of credit limit that you're applying for, right? Obviously, that's not going to work out. You need to build your way up. You need to show patterns of you know, using the type of credit limits, and then paying it off on a consistent basis, on a frequent basis before increasing that limit. So they might start you off as small, but you need to prove to them you can actually handle that type of credit in the first place, right? And then comparable credit is where they look at other banks and see what they issue you, and then they try to match that or give you just a slightly higher just to grab your business in that case. Your income, this one's pretty straightforward. The more you earn, the higher the limit you will be. At the end of the day, it's based on your household income and on the business, your projected income, right? Banks often think that 10 to 15% of your yearly income as a ballpark figure for your credit limit. They will also look at how your income stack against any debt that you have, right? So they also account for the rental income that you're paying for rent, right? Any what your DTI ratio is. So they take the average of all of the minimum balance or your average payments that you're making with, you know, um, other credit card companies, other loans, student loans, mortgages, they stack that, compare it, and they have like algorithm formulas in place to make sure that you stay under 40%, because that would be anything above 40% would just put them at the risk level, right? How much credit you're using, that's utilization rate. And then it's basically how much of available credit you're using. If you're not maxing out your cards and keeping your balances low, it looks good in the banks. In the eyes of the banks, they see you as someone who doesn't really rely too much on credit, so they might be comfortable giving you a higher limit in this case. Interesting thing to note is that a higher credit limit and using a small part of it is actually a good thing. It shows the banks that are responsible and not just rely on credit cards to get by. And this is a huge point in your favor when you're looking to get more credit, right? Next up, bankruptcy. When it comes to borrowing money, banks take a really close look at your credit history, especially if you went through bankruptcy. There are two main types of personal bankruptcy in the US: Chapter 7, Chapter 13. Chapter 7 is also known as your liquidation bankruptcy. This is where most of your unsecured debt, like credit card bills, get wiped out. For lenders, this is a bit of a red flag. It basically tells them that you were in a spot before that you couldn't pay back all of the unsecured debt and you need to kind of like reset or start over. So if you got a Chapter 7 bankruptcy on your record, then banks are just going to be a little more hesitant to lend to you, and they're probably going to start you off with like a smaller credit card, and then you have to work your way up based on your relationship and your on-time payments over the past years, right? Chapter 13 is a little bit different. This is what we call a wage earners plan. In this case, you settle a plan to pay back all of your debt over 3 to 5 years. Lenders usually see this as a better light, right? Way better than Chapter 7 in this case, where you're completely resetting, but still shows that you're trying to pay off the debt instead of just erasing them. Sticking to a Chapter 13 repayment plan can look good to the banks, and it looks like you're proving to handle your financial responsibilities. The timing of the bankruptcy also matters a lot. If it happened several years ago and you've been managing your money well ever since, lenders might not be as worried. But if it happened pretty frequently or pretty recently, like a year ago, then it has much of a larger impact, right? So the duration of how long the bankruptcy has been in your credit report really matters at the end of the day too, right? Okay, cool. Um, Sorry, just gonna drink some water. I'm so passionate about talking about this. Automated decisioning. You probably didn't know about this when you apply for the credit card. About 80% of the time, a computer algorithm decides whether you get the card or not. And this just shows how much banks rely on the automated systems now. Just because AI is starting to increase, banks are getting smarter when it comes to hiring engineers, making sure that they're not spending much money on like day-to-day operational people, and that's how they make more money, right? So a lot of that is rely on automated decisioning and these complex, algorithm in place, and these systems are super quick to look through a lot of your financial information, like your credit score, income, and how much debt you have compared to your income and your financial habits, right? So this is why it's so important. It's because if they rely on automated systems or algorithm to kind of make decisions, and what the algorithms are looking for is pretty much what's on your credit report and what's happening outside from they're looking at your credit report, and then they're also looking at your history with other lenders institution. We can sort of like play this game with them. We can kind of like make that perception or make tweaks on certain stuff that we know the banks are going to focus on looking at before making a decision or giving you a limit on the type of cards or lines that you're applying for, right? So it gives us that advantage, that edge, because we know exactly what they're looking for, and we can kind of like tweak those little factors in order to make sense to them to get what we want. And the goal is to make fast and fair decision about who gets credit. But not every application gets started out with the computer. The other 20%, sometimes this is where they verify, need to take a look. This usually happens when the algorithm can make a clear call or something in your application need a closer look. Maybe there's something unusual in your credit history, your credit score is on edge, and there's some information that doesn't add up, right? So this is where having a fraud alert, a credit freeze on your credit report might cause some confusion in the algorithm, which requires a lot of these applications to go into pending status, requiring that human to kind of like step in and really analyze everything, or just to verify your identity over the call. Most of the time, the reason why it goes into pending or into decline automatically is because you have fraud alert on there. They need to verify. It's kind of like stated on your credit report that they need to verify with you by giving you a call before approving it, or it's because the information that you list on your application isn't aligned with what they see on your credit report. So you want to make sure all of your addresses match up, and what you're stating on those application matches up everything that you're putting on the application, and it cross-reference to your credit report, the information on the credit report, and the information on the Secretary of State, right? They take a deeper look, considering things like why there might be a bad in your credit report, explanations for the changes of income, or signs that you have gotten way better at handling your money. Computer handle clear cut cases quickly, while the human touch is there for situations that needs a little bit more consideration. However, the fact that most decisions are made by algorithms, such as how bank is leaning towards technology, right? Income verification. When you apply for credit cards, especially with large banks, lenders usually don't go deeper and check to see if the income you say you earn is correct. Instead, they look at your credit report and use that to figure out if your reported income makes sense given your overall financial situation, right? Obviously, if you're someone that's coming in with like three primary accounts with $500 credit limit, and then you're stating that you're making 250,000, it's just a little bit unrealistic. It's just like, okay, cool. If you're making 250,000, why is the other banks giving you $500 credit limit, right? Obviously that story doesn't add up. So that's why it's so important to really understand and be realistic with yourself with how much funding you can get given what's stated on your credit report. That way they can process application faster, look at your credit habits to get an idea of how much you'd be earning. So for example, if you're, let's just say you have a high income but your credit report show that you have a small loan, or your credit card habits doesn't really match up with someone making that much money, lenders are going to be suspicious. This is where extra verification comes in, and they just want to make sure that whatever you're saying is actually true. If things doesn't add up, it could lead to them saying no to your application. But if there's something really off about your income, you stated like it doesn't fit at all with your credit history, the lender might ask for proof of income. That's where we kind of like understand how to stay away from this, and then make sure we be a little bit more realistic, but also have a high chance of getting approved for certain credit cards that we apply for, right? Or the type of limits that we're looking for. And this is more likely if other parts of your application also make them question how creditworthy you are. But if you have really solid credit history, then they most likely wouldn't ask for proof of income. Age discrimination. So this is a big one. We recently got, this 18-year-old a $40,000 credit card limit. We're able to finesse the system a little bit, but the banks caught on really quickly. Within the first month, they audit his kind of like his age, and then decided that, hey, given his age, the likelihood of him making that much money and able to, handle this type of credit is going to be so risky. So they decided to shut his account down, right? But lawfully, a bank can not discriminate based on age, but that doesn't really stop them from doing this. It's really about how your age relates to your credit history. So let's just say you're older but don't have much of a credit history. Lenders will be a little bit suspicious. They would wonder why someone who's been around for such a long time hasn't used credit or financial products as much. They might think you have been a little bit unstable in the past. Maybe it might be a different story. You just haven't have any credit and you've been using cash the entire time. That's totally understandable, right? But in most cases, they might just say, hey, have you been to credit repair? Has everything been wiped off that we're not seeing on your credit report? And they start to come up with all of these skepticism. On the other hand, if you're younger and you don't have much credit history, that's usually seen as pretty normal. It's expected that younger folks are just starting out with their financial lives, so a short credit history isn't really much of a big deal. But if a seasoned person hasn't used credit much, lenders might be cautious. They might think that there's a lot of risk here, like maybe there were financial problems in the past or a tendency to steer clear of credit. And this is the biggest one, banking relationship. When the bank is judging your application, having a history with the bank would definitely help, especially when it comes to computer deciding. Let's just say you're using automated system for your credit application. The computer will look at your history with the bank, right? That's why it's important. Sometimes we ask you to open up checking account, deposit accounts, and then start depositing X amount of money in there, because the moment that you deposit X amount of money in there, they start giving you a rating. The rating is determined on how much you deposit and then what your kind of like credit report or the type of consumer you are ahead of time when they sort of like take you on, right? So there's a rating, and you want to make sure you place yourself at the highest rating, because that ultimately will influence and weigh really heavily in the type of limits that you get approved for and the type of products that you're able to kind of like apply for too. So things like how much you keep in your bank account, if you have loans with them before, your overall relationship with the bank can work in your favor. If you have a good track record, like keeping solid balances, paying off loans, and using other bank features like balance transfer offers, the computer might see you as a safer bet. And this could also mean better terms or higher chance of getting approved because the system see you as a lower risk to your history with the bank, right? Lending appetite, banks will also have certain appetite for lending that you have no control over. And that really comes down to what the Federal Reserve is doing, what the Fed rates are, what's going on with the economy, etc. And their willingness to lend you money is going to change based on how their business is performing. Number one, how much money they lend in the first place, and just the global market condition. Again, going back to the Fed rate, and then how well their current business model is performing, etc. And their appetite will move around from month to month and year to year. Banks will also try to keep an eye on how their current loans are doing, right? That's the biggest part because they make the most money from loans, right? They look at things like how many people are paying back on time, how much people they're making from these loans. If they're facing a lot of risk or not making as much money, they might consider being a little bit more cautious, and then with how lending underwriting will work, and then also lowering credit limits just to decrease the chances of people defaulting and not being able to make payments, therefore loss of business, right? This could mean that they only lend to people with better credit score, check your income more thoroughly, or not really offer as much credit or loans in the meantime. Basically, their past experience with the loans would tell you how risky it is to lend more money. Next up, banks have to follow some rules about how much money they should have available. It's a safety net, right? The money is meant to cover any unexpected losses. If a bank is close to using all of its safety net, then it's probably going to slow down on giving new loans. They need to make sure they follow the rules and not put themselves at a financial risk. On the other hand, if they have gotten more money, enough money saved up, they might be willing to lend a lot more, maybe even relaxing the rules to a bit to attract more customers. And ultimately it comes down to what the economy is doing, that really influence how banks are going to issue lines of credit, money, etc. Right? When things are doing well, jobs are stable, businesses are doing good, banks are more likely to lend more money freely. They're not too worried about people not paying back or defaulting. But when the economy isn't doing great, like during recessions, banks tend to be more cautious and tightening up their lending conditions. They worry about people losing their job, business struggling, and the last thing they want to do is pay their credit card bill because understanding the hierarchy of needs, people will want to pay for their survival first before making any payments to to other causes, which means money they might not get their money back. So in tough economic times, they're likely to be strict about who they lend to. And the last but not least, your zip code really matters, and this goes hand to hand to kind of like the income that you're reporting. They will also like to cross reference that based on your zip code. So what I would do is, like, if your zip code is 915, just go on Google and then search what is the medium income, household income for that, and then you want to stick between that range, right? So obviously if you live in a suburban area with higher income, the chances of you getting a higher limit is a lot higher than someone that lives in a like on Skid Row, for example, right? Like full of homelessness, right? So these are all of the external factors that you guys just need to be aware of. It's so important, but we're not taught, especially like all of the surface level stuff that you see on YouTube. But there is another side of things that banks look at and how they underwrite, and you just want to put yourself in their shoes and really think like them. Because once we start thinking like them, we understand what they're trying to look for, in terms of what a reasonable borrower is, the ideal customer is, and we can kind of like tweak certain stuff to make ourselves seem like the ideal customer and do changes, make certain habits, decisions that will allow us to really capitalize on this, right? So I know this is a long PowerPoint. If you guys have any questions, let me know. But hope you guys grabbed a lot of value on this, and see you guys next time.